The Philippine economy grows 5.4% in the first quarter of 2025, fueled by strong household spending. But the figure is still slower than what was recorded in the same period last year. With inflation cooling and interest rates easing, officials say there's now more room to stimulate investments and sustain momentum through the rest of the year. Jin Kim has the details.
The Philippine economy grew by 5.4% in the first quarter of 2025, according to the latest data from the Philippine Statistics Authority. Although slightly higher than the previous quarter, this performance is a sharp deceleration from the 5.9% growth recorded in the same period last year.
So while this pace falls short of our initial expectations, it reflects developments from the broader global context of tempered economic activity amid persistent uncertainties.
The country's total economic output reached 6.587 trillion pesos. Key drivers of growth included retail trade, financial services, and manufacturing, underscoring the continued importance of domestic commerce and services to economic activity. On the expenditure side, household spending remained the strongest contributor to growth, followed by public expenditure and construction investments, reflecting robust domestic demand.
Domestic demand remained a key pillar of growth. Easing food inflation supported household final consumption, which grew by 5.3% year on year, which is faster than the 4.7% growth recorded in Q4.
Trade remained a drag on growth as imports outpaced exports, resulting in another quarter of trade deficit. While gross national income rose by 7.5%, DepDev officials acknowledged that breaking out of the middle income trap remains a structural challenge.
Our challenge is really to get out of this middle income trap. And to be able to get out of this middle income trap very well, hopefully very quickly, it's really about being able to diversify. So it has to do with economic diversification, has to do with technology adoption. With technology adoption, then you can have greater labor productivity.
With inflation easing and interest rates softening, DepDev believes there is room for monetary policy to support capital markets and investment activity.
We think that there's really room for more easing. And if we can have deep capital markets, that's the first one, and if we can have a lower cost of financing, lower cost of investments by this positive policy action, then that can really boost investments. So it will be really very positive for growth.
Despite the slowdown, the government is still aiming for its full-year GDP target of 6 to 7%. According to DepDev, the economy needs to grow by at least 6.2% for the rest of the year to meet the low end of that range, a pace they still consider attainable.
So for the rest of the year, we need to grow by 6.2% in order to achieve the lower end of or in order to grow by 6% for the whole year of 2025. This is actually within the range of possibilities.
Next week, the Development Budget Coordination Committee is set to convene to review its macroeconomic assumptions in light of the latest GDP data. Jin Kim, Billionaire News Channel.